Surfs Up. Learn to ride the F&O waves only on Bloomberg Quint with Agam Vakil.
Surfs Up on Bloomberg Quint. This is Agam Vakil, and just like always, we're here to get a perspective on the futures and options markets in Indian equities. Now, it may have seemed like a week where there is little happening, but the benchmark indices have gained to make new highs, with the Nifty 50 index holding on to 9,600. Consolidation around the mark continues. Maximum open interest in options, which broadly suggests a range in the near term, is with the 9,400 put and the 9,700 call. The India Volatility Index is still below 12 and near record lows, with little change over the last week. But as we move into trade next week, what are the cues that are telling us about the direction of the Nifty, and how long will the VIX trade at such low levels? Are there themes poised to give sharp moves? Let's find out. Joining us today and taking us through these questions is Hemant Nahata, Senior Derivatives Analyst at IIFL Wealth and Asset Management. Thanks for joining us, Hemant. Starting off with the first question, where are you seeing the Nifty headed into the coming week?
Hi, good morning, Agam. As you perfectly said, that we have been on a roller coaster ride for Nifty, and the broad-mark indices are touching new highs. The one thing that I want to point out to the viewers and you is, in this fiscal year, we haven't had a correction which is deeper than 200 points on Nifty. That's something which is very unusual for the 6-month trend that we are seeing in the markets. Now for this particular series, we started this series with 9600 call having the maximum open interest. Now within the first 3 days or 4 days of this series, we have already conquered that. And now the open interest base on the call side has been shifting towards 9700 and 9800. We have started to believe that 95, 9400 is a very, very strong support for this market. On a higher side, 9750 to 9800 could act as a near-term resistance. But whenever we have seen such kind of an open interest positions actually moving towards a higher range of the series during the very starting of the series, we have seen that the market generally tend to follow that particular direction only. So in the near term, for the very first half of this particular series, I think the market is heading up towards 9750 to 9800.
There you have it. Expectations of the Nifty moving towards 9,700. But based on what you are looking at when it comes to the indices, what are your calls on some stocks, perhaps some strategies that you intend to employ, and what you are advising your clients to do?
See, we are doing a couple of things that we think Nifty is broadly within a range of 9,500 to 9,800 for at least the next 6-7 days, unless and until something comes up globally. So that is our broadly range, and we have a couple of strategies that we are asking our clients to do. The first one is an pair trade on an HDFC and HDFC Bank. See, Agam, this HDFC Bank has never traded at a ratio, at a price spread below parity level, which is below 1. Now currently it is trading at a parity level of 0.97. Now what we have seen is in the past, there was a rumors about HDFC Bank getting merged into HDFC. At that point of time, the lowest point that it was 0.95. Currently, it is trading at 0.97, and it is very close to its third standard deviation on the lower band, which clearly indicates that it's a risk reversal trade is quite possible in this counter, where we have to go long on HDFC and simultaneously have to short an HDFC Bank. This is already a rupee neutral strategy, so one need not take any cash position in this one. The second one that we are recommending to our clients is a long short on ACC and Ambuja, where we are going long on Ambuja and we are shorting ACC. Again, similar kind of a story. It has never traded at a band of 0.15 in the past 18 months, and it's very close to its third standard deviation. With rumors floating around about ACC and Ambuja merger, we don't think so this spread is going to widen further, and we are expecting Ambuja to outperform ACC in the near term. Thereby a buy on Ambuja and a sell on ACC. On a plain vanilla strategy, we are asking clients to buy stocks like Apollo Tyres, KTK Bank, which are looking promising from a expiry time frame.
There you have some very, very interesting trades when it comes to HDFC Twins as well as the major cement companies. But once again, I'm going to come down to Derivatives 101, and I want to remind our audiences that we're open and inviting questions. Hemant, the question for this week comes from Ramesh Mehta, and he asks, what is the difference and when does one sell a call and buy a put?
See, there are two things you can do about sell a call and buy a put when you're sure that the market is not going higher than this particular range and you expect the stock to fall down. Some people do this, and this is probably called as a synthetic trade, where you buy into puts by taking their premiums or by actually getting premiums from call. So ultimately, you don't finance your puts. You just take premiums from your call and simultaneously buy that. From that amount of premium, you buy those puts. It generally happens when you are very sure that the market is going to go down and it is not going to go up.
Okay, so there you have it. I hope that answers your question, Ramesh. But that is all that we have for this week. Hemant, thanks again for joining us. And as for you guys, we'll see you next week on Surf's Up only on Bloomberg Quint. Stay tuned in.